What is going on, everyone? Welcome to Investment for Beginner. My name is Andy and thank you for checking out this channel where I make videos about basic introduction to investment and investing in general. If you're new to investing or just curious about investing, check out the playlist where I go over basic introduction to investment. And if you found any of my video useful or insightful, consider sharing it with your friends and family so we can all achieve financial independent freedom. I also highly recommend watching the video What You Need to Know Before You Start Investing. I believe this video will really help you set your mindset to build foundation of your portfolio. Alright, so in this episode, we're going to talk about what we should do when the stock market crash and our investment shrink. By the way, if I missed out on any other recommendation, please comment below and share it with the community. I'll create a comment collection of advice and tips from the community, pin it to the very top of the comment section, and make sure to give the credit to the user. As a quick disclaimer, I am not a licensed financial advisor, and if you truly want, you can seek a professional financial advisor for their advice. I am making this video to entertain you, the idea of what people can do when the market crash. Alright, so the very first thing we have to remember is don't panic and don't be too emotional. It's okay to be like, oh snap, alright, stock market is shaking things up. What we don't want to do is, oh my god, this is the end, I gotta sell everything. We have to remember that making decisions based on our emotion, especially fear and panic, will enable us to think clearly and rationally. So we have to do our best to control our emotion. They're the most powerful tool in our decision making. Alright, second, we can choose to do nothing. That's right, you can just sit back and watch the stock market crash. Stock market crash is bound to happen, but they are also bound to recover. We just need to buckle down, don't get too emotional, and just ride the crisis. Looking at this chart, you can see in the past 20 years, S&P 500 stock market crashed twice in year 2000 and at the end of 2007. In year 2000, stock market crashed in August when S&P 500 was at 1,515 points, and it just continued to go down until 2003. In March of 2003, when the S&P 500 reached 838 points, that's when the market began to recover. It took stock market almost 3 years and cost 677 points before it actually recovered. Unfortunately, this recovery doesn't last too long because after a little over 4 years, the stock market crashed again until February of 2009 when the market was at 745 points, lower than the market crash in 2000. But very fortunately, the market crashed for only about a year and a half instead of 3 years from year 2000. So what I'm getting here is that we don't know exactly how long the stock market will be crashing when it does crash. I know that 3 years of stock market crashing is very long for many investors, and it may be very difficult to just ride the market crash. But what I recommend is that you look at the stock market crash as if it was a Black Friday sale. If you want to invest more on your long-term investment, this is the best opportunity to buy them. Change the way you view the crisis. Hopefully this will help you change how your emotion will be. Okay, so that's two advice combined into one. Do nothing and buy more when the market crash. So next, at number 4, determine when you're gonna sell your short-term investment. I don't believe holding on to short-term investment is the best idea during the market crash. I'm not saying that they won't recover, but like their name said, they're short-term. I understand that one person short-term can be a year, while other person short-term can be considered 3 years. So you have to decide how long or short your short-term is. Now with the short-term investment, I try to always set a sell point. What I mean by that is when the short-term investment falls certain percentage or dollar, that's when I sell it. For example, let's say I bought company Alpha for $100. Now from the moment that I bought it, I will tolerate 10% loss. That means if the price of company Alpha fall right after I bought them, I will wait it out until it falls down to $90 before I sell them. Like I said, this is an example, so the 10% can be 15% or even 20%, depending on how much I'm willing to risk my loss, and this will be based on how much I spend total to invest in the company. Now, if the company alpha goes up for $100, then I would set the sell point a little bit higher depending on how much the price went up. If the price goes up from $100 to $110, I would set the sell point at $90. But if the price goes up continuously, my sell point will also go up from $90 to $100 and $110 and so forth. You should also keep in mind how much of benefit of the doubt amount you want to give to your short-term investment. If the price goes up to $200, do you give them $50 of loss before you sell them? Or do you give them $10 of loss before you sell them? If your sell point is $150, then that gives $200 investment room to dip in case something unexpected happens, an opportunity to recover. If your sell point is at $190 for your $200 investment, that doesn't really give them a room to recover if they fall below $190. So this really depends on how much your tolerance is going to be. When I sell the short-term investment, I will use the capital gain I earn to either invest in long-term investment or another short-term investment that has potential to grow. And at number 5, what you can do when the stock market crash is just simply sell all your investment. This is very risky because you won't necessarily know if the stock market is going through a crash or if it just tripped and fell and back up again like it did on late 2018. If you sold all your investment, you have to decide when to start investing with your cash again. If the stock market did crash, you will be able to buy more investment. If the stock market didn't crash, then you're gonna be spending more money to buy the same amount of share, unless you want to spend those money to buy something else completely different. This is why timing the market is riskier than just leaving your investment in the market. You have to know when you sell the investment and you have to know when to buy the investment. If you don't get these two right, then you would have been better not timing the market at all. This is why it is better for the majority of the investor to just stay in the market through all the ups and downs instead of trying to time the market. In order to protect your portfolio better from the big loss in stock market crash, you need to diversify your investment. Some sector may get hit harder than the other sector, and if you happen to have all your investment in one sector only and that sector get hit the hardest, you're gonna lose extremely a lot of money. So invest smart, protect yourself better by creating big diversity in your portfolio. Using Fidelity, there are 11 sectors and I'll just list them in a chart so you can pause and read them if you want. Each of these 11 sectors has anywhere from 2 to 14 industry. Roughly, half of this industry have no sub-industry, but the other half of the industry has anywhere from 2 to 8 sub-industry. So there are a good amount of diversity you can build for your portfolio. So take the opportunity, take your time, do your research, and do your study, and protect yourself a little bit better. Now, if you're someone who is closer to the age of retirement, you will need to change your investment completely. What I mean by that is if your portfolio is made of mostly in stock, you need to start shifting toward ETF, mutual fund, and bond. I'll link in description below what these three are so you can understand why these are safer than the stock. The reason why you want to avoid stock is because stock may take longer time for recover and you may not have that much time for your portfolio to recover when you retire and not working. That is it for what you can do during the market crash and how to protect your portfolio from the crash. Like I mentioned before, if I missed out on any good recommendation, please comment below so I can give you credit for the recommendation and share it with the rest of the community so we can all learn together. More information and knowledge we share among each other, more prepared and smarter we will be as an investor. Thank you so much for watching this episode. I hope this video helped you prepare for the worst, because since the whole Iran attack, things were getting a little interesting in stock market to say the least. So I figured this might be perfect time to make this video. Anyway, if you enjoyed the video, consider subscribing so you won't miss out on future video about investment and investing in general. Also, don't forget to hit that notification bell so you know when the video goes on live. Super smashing the like button is always appreciated. Thank you and invest wisely.